Hello and welcome back to the channel. In today's video, we will discuss transaction monitoring and reporting part 3. As this is the last video of anti-money laundering, if you have not watched its part first and second, then watch first. Now I am starting its part 3, AML monitoring and fraud prevention with detailed explanation with real examples. AML anti-money laundering monitoring is essential for identifying, preventing and mitigating fraud. Financial institutions must implement strict monitoring systems to detect suspicious activities and prevent fraud. Below are key areas of concern regarding customer-induced and staff-related frauds, along with necessary precautions. A. Customer-induced frauds. These frauds involve customers manipulating the banking system for illegal gains. Various types of fraudulent activities often require active monitoring and preventive measures. First, fraudulent RTGS walk-in customer account. Example: a walk-in customer approaches a bank branch and requests an RTGS real-time gross settlement transfer. They present fake documents to open an account and transfer a large sum to another account, usually leaving insufficient time for verification. Once the transaction is completed, the funds disappear. Preventive measures. First, verify the customer's identity thoroughly before allowing RTGS transactions. Second, implement strict KYC know your customer procedures, especially for new accounts. Limit RTGS transactions for new accounts within a short time frame. 2. Fraudulent RTGS current account of proprietorship firm. Example: a small proprietorship firm opens a current account. The proprietor initiates high-value RTGS transfers to several different accounts, and the funds quickly move abroad or to multiple mule accounts. After a short period, the account is closed, leaving no trace of the fraud. Preventive measures. First, monitor high-value RTGS transactions, particularly from accounts with no prior history of such activities. Second, scrutinize proprietorship accounts with unusual or sudden spikes in transactions. Third, place transaction limits on new accounts until a proper history is built. Fourth, current account of proprietorship firm. Example: a proprietorship firm with minimal business activity opens a current account. Within a few days, significant sums are deposited, followed by immediate transfers. These funds are often connected to money laundering schemes. Preventive measures. First, monitor deposits into proprietorship accounts for consistency with the firm's business nature. Second, review transaction patterns to identify any discrepancies or sudden spikes in activity. Third, ensure documentation provided by proprietorship firms is legitimate and verified before enabling high volume transactions. 4. Money mules operations in accounts. Money mules are individuals used by criminals to transfer illicit funds, often unknowingly. Example: a customer is recruited to receive funds into their account with a promise of earning a commission. Once the money is deposited, the customer transfers it to a third party, often across borders. The money is from illegal activities like drug trafficking or cybercrime. The mule is often unaware, but their account is flagged for suspicious activity. Preventive measures. First, educate customers about the risks of becoming money mules. Second, implement transaction monitoring systems that flag unusual patterns, such as frequent transfers to high-risk countries. Third, regularly review accounts for large incoming and outgoing transactions without economic rationale. B. Staff-related frauds. Staff-related fraud occurs when employees misuse their access or authority to commit fraud. Example: a bank employee with access to high-value transactions manipulates the system by approving a fraudulent loan for a customer in exchange for a kickback. Alternatively, they may transfer funds from dormant accounts into personal or third party accounts. Its preventive measures. First is implement strict internal controls and conduct regular audits of staff activities. Second is use dual authorization protocols for high value transactions. Third, enforce a robust whistleblower policy and encourage staff to report suspicious activities. C. Staff carelessness. Carelessness refers to staff negligence that allows fraud to occur whether through oversight or lax monitoring. Example: a bank employee skips crucial steps in the KYC process, enabling a fraudster to open multiple fake accounts. These accounts are later used for laundering money. The employee's failure to verify documents properly leads to significant financial losses for the institution. Its preventive measures. First, provide regular training on AML regulations and the importance of compliance. Second, automate key verification processes to reduce human error. Third, hold staff accountable for non-compliance or negligence. D. Common precautions on new accounts. When opening new accounts, banks must take specific precautions to prevent fraud and mitigate risks. Example: a customer opens a new account and immediately deposits a large sum, followed by a series of wire transfers to offshore accounts. Without proper verification, the bank processes these transactions, later discovering the account was used for money laundering. Conclusion: AML monitoring and fraud prevention require a robust framework combining technology, employee vigilance, and strong internal controls. Identifying customer induced and staff related fraud patterns through real time transaction monitoring, implementing preventing measures, and educating staff are critical in reducing the risks associated with fraud. Now, coming to next topic, maintaining records in AML compliance. Maintaining records is a crucial part of anti money laundering compliance to ensure financial institutions can track, monitor, and report suspicious activities to authorities. Proper documentation helps in conducting audits, identifying money laundering patterns, and assisting law enforcement during investigations. A. Types of records. Financial institutions are required to maintain several types of records under IML regulations. These records include transactional data and customer identity information. First, records of transactions. These records include all customer transactions, such as deposits, withdrawals, fund transfers, and more. They are necessary for monitoring unusual activity and providing an audit trail. Real world example: a customer frequently deposits large sums of money into their account and subsequently wires it to offshore accounts. The bank maintains a detailed record of each deposit, including the amount, date, and recipient information. These records help identify that the customer's behavior may fit a money laundering typology, leading to a suspicious transaction report STR. Second, identity documents. These are documents provided by customers to verify their identity and meet Know Your Customer standards. Common documents include government issued IDs, proof of address, and signatures. Real world example: a customer opens an account by providing a passport, utility bill, and tax ID. The bank retains copies of these documents to verify the customer's identity. Later, the customer is linked to illegal activities and the bank is required to provide this documentation to law enforcement agencies as part of an investigation. B. Period of retention. Retention periods specify how long financial institutions must maintain transaction records, KYC documents, and other relevant information. These periods are often defined by regulatory authorities and vary depending on the nature of the records. First, transaction records. Transaction records must be kept for a set number of years, usually between 5 to 10 years, depending on local regulations. Real world example: a bank detects unusual activity in an account that was active 5 years ago. Authorities request historical transaction records for investigation. Because the bank complied with AML retention requirements, it is able to provide the records dating back 5 years, helping to uncover a large money laundering network. Second, identity or other know your customer documents. Know your customer documents must also be retained for a specific period after the customer relationship ends. Real world example. A customer closes their account, but 2 years later, law enforcement investigates the individual for fraud. The bank retains copies of the customer's identity documents and know your customer information for the required period, allowing authorities to access the necessary information. Third, other documents information. This includes any supporting documents, correspondence, or evidence related to the transaction or customer relationship. Real world example. A bank's compliance team collects emails, loan agreements, and account activity logs as part of an investigation into a suspicious customer. These documents are kept as part of the transaction records and retained for the mandated period. C. Manner of maintaining information. The way records are maintained is just as important as the content of the records. Institutions must ensure that records are stored securely, are easily retrievable, and are in a format that allows quick access. 1. Secure and organized storage. Records must be securely stored to protect against unauthorized access, data breaches, and physical damage. This applies to both physical and digital records. Real world example. A bank uses a secure database to store all know your customer documents and transaction histories. Access to the database is restricted to authorized personnel only, and the data is backed up regularly to prevent loss in case of a system failure. 2. Accessibility and retrieval. Records must be maintained in such a way that they are easily retrievable when required for audits, investigations, or regulatory reporting. Real world example. Financial institution implements an automated system to archive transaction records and know your customer documents. When law enforcement requests information on a specific customer, the compliance team can retrieve the necessary records within minutes, ensuring swift cooperation with authorities. 3. Digital VS. Physical records. Increasingly, financial institutions use these digital systems to maintain records, but they must ensure the systems meet regulatory standards for data integrity and security. Real world example. A bank migrates all its KYC and transaction records to a digital format, encrypting the data to prevent breaches. This ensures that records are secure and can be retrieved instantly if needed for compliance checks or investigations. Conclusion. Maintaining accurate, secure, and readily available records is essential for complying with AML regulations. Financial institutions must focus on keeping detailed records of transactions, identity documents, and supporting information while ensuring compliance with retention periods and secure storage methods. Proper record keeping helps detect and prevent fraud, assists in investigations, and strengthens the institution's defense against money laundering. So, we have completed this chapter of part 3 of transaction monitoring and reporting. In the next lecture, we will see its know your customer. If you want to get update of this topic, then please press bell icon of this channel. Thank you so much for watching this video.